What's up, everybody? Today, in this quick 3-minute video, I'm going to go over the two main factors that you need to look for when you're designing a life insurance contract that can pay you for the rest of your life. Okay, when you look at a life insurance company that's going to create a contract that will pay you while you're alive, tax-exempt cash flow, there's two types of insurance companies you can go towards. One is called a stock company. And a stock company is just like it says. You can invest in that company in the form of owning different stocks. So it's a publicly traded company. You can buy shares on Wall Street. And when a company is profitable, the profits go to the shareholders. You also could invest in what's called a mutual insurance company. A mutual insurance company is different because the owners of the mutual insurance company are actually the policy owners. Okay, so the profits go back to the policy owners who own the company. So you have a stock company that you can purchase on Wall Street. Then you have a mutual company, which is essentially kind of a private company that you can share in the profits. Now, when a company is profitable, they're going to pay you dividends. And dividends, if you know much about investing on Wall Street, when dividends get paid to you, when you own a stock and I get dividends, they are taxable. Now, this is not tax advice. This is just education purposes only. I got to say that. But a stock company, when they pay you dividends, they will pay you taxable dividends. Okay? A mutual company, when a mutual company pays dividends, actually, that dividend comes to you tax-free. Now, there's some caveats there. This is high-level education, so it's not like 100% detailed, but essentially, you can get tax-free dividends or tax-free growth inside of an insurance contract if you choose a mutual company to purchase your product through. Okay? Now that we have that covered, let's talk about this. This is a kind of a goofy name, but it's a really easy concept to understand. There's direct recognition, and there's non-direct recognition dividends. Okay, so you have direct recognition, and then you have non-direct recognition. Big difference between these two. Essentially, it's direct recognition versus non-direct recognition. So they're going to directly recognize you using the money, or they're not going to recognize you using the money. Let me give you an example. Look, and the cash value inside that policy is $1 million. Not the death benefit, but the cash value. So that means you have $1 million inside of a policy that is available for use while you're alive. Okay, so let's do $1 million here in cash value. Now, there's a big difference between direct and non-direct. Follow me on this. Let's say my dividend is around 5% in this example. I have a 5% dividend from a direct recognition company and a 5% dividend from a non-direct recognition company. Now, let me use you an example for a business owner. If you know that there's a piece of equipment that you need to buy that you know you can increase your profit or increase your business, increase your margin perhaps, and you know that if you can make that purchase, it's going to have a massive effect on the rate of return for the company. You probably are familiar with how to have a line of credit at the bank. A line of credit at the bank, they want their monthly payments back. You have to qualify. The list goes on. There's a lot of red tape when you access that money. Life insurance cash value can be used just like a line of credit without all the red tape. Now, let me go over how it works. If I have $1 million in cash value, and let's say I take out $500,000 to go make this purchase for my business, and that purchase is going to increase the rate of return. Well, when the insurance companies pay the dividend, the stock company is completely different than the direct recognition company is different than the non-direct recognition company. Okay? So if I have a 5% dividend and I have $500,000 in cash value and I've taken out $500,000 as a loan, the direct recognition company will directly recognize this money that's being taken out for your company. So they're going to pay a dividend of the 5% on what's ever remaining, the $500,000. So what's 5% of $500,000? It's going to be around a $25,000 dividend. So you get about $25,000 of growth in that year. Non-direct recognition companies do not directly recognize you taking the loan. This is beautiful, guys. Watch this. Because they don't recognize you taking the money out, they are going to pay you dividends on the gross amount of cash value. the full million. They don't recognize the $500,000 loan. So what's 5% of $1 million? This company is going to pay you a $50,000 dividend. Why this is so important is you know that you're going to get a good rate of return in your business. And every dollar that leaves your business is technically taken away from the rate of return that you could use. A life insurance contract that's properly structured from a mutual company with non-direct recognition dividends is going to continue to grow even though your money's not in the policy. You can use your money for whatever you'd like, and the company doesn't recognize the loan that you're taking. So, this is what's beautiful about this. When, as a business owner, at some point, if you do want to sell, how can you design a cash flow strategy that can continue to pay you cash flow for the rest of your life, but doesn't offset or hurt your ability to grow the rate of return? It's very easy. You get a policy started way down here. And as the policy starts to grow, you don't have to pay for it. Why does that matter? Because the insurance company is going to continue to pay dividends even though your money is in your business. Now, if you do this the right way, you can even get a third party to pay for whatever your premium is or whatever that contribution that you want it to be. And so while you're funding your business over all this time and you're ready to exit the company, where do you put the money? You can put the money in down here. So instead of starting a contract here with slow growth, you can take advantage of that compounding that's taken place for the 5, 6, 7, 8, 9 years before you actually put money into your own contract. So when you look for an insurance contract, make sure it's a mutual company so that you can share in their profits, and then make sure that the dividends are non-direct recognition so that they'll continue to pay the dividends even though you're not funding your strategy. Now, if you want to learn how to fund these and have a third party get this going so that when you do exit your company, click the link below and set up a free 30-minute consultation. I'll kind of walk you through, me or someone from my team will walk you through how to set this up, and hopefully we can help out.